to take. Judy Lynn, I might as well begin, and if we just have two at the moment, we'll go over this rather quickly. Can you see the slide that I have?
No.
Not yet. Okay, I always seem to have some difficulty with this. Okay. Can you see this?
Oh, yes.
Oh, okay, good. That wasn't nearly as bad as the previous weeks. Okay, I seem to be getting this under control. Let me begin with a change in schedule. I'll send this out on the WhatsApp once we finish. But let me go over some changes to the schedule for the remaining weeks. Today is December 13th, so I had programmed chapters 10 and 11 today. We'll continue with that. For the remaining weeks, we'll just go one chapter at a time. So next week on the 20th, we'll just go chapter 12. And then I will prepare for you a midterm exam on the 20th as well. We will not have class on the 27th. That would be Christmas week. So you will have then 2 weeks to submit the exam, and that will bring us up to January 3rd. So no class on the 27th. You'll have 2 weeks from the 20th to January 3rd to answer a few questions for me. We will then continue one chapter at a time. I do have that in Moodle. Let me just bring that up for a second.
So Professor will meet until January?
Yes, according to
I can hear you, Professor. You're choppy.
yeah, let me just pull up the okay. Yes, according to what I was asked from Sarah, we'll continue until the 24th. But we'll go
January 24, Professor, until January 24?
Yes. But we'll go one chapter at a time. So on January 3rd, we'll just go chapter 13. And then on the 10th, chapter 18. It's all in Moodle. And it's chapter 21st, 21, and then on the 24th, chapter 22. It's all posted on Moodle. So one chapter a week rather than two. I'm trying to select the areas that I think that would be most helpful to you. And then on the 24th, I will give you the final exam to submit a few days later.
Oh, did you try to talk to the administration about, because we are having our 2 courses will end in this December, and we need a break before we'll take our thesis?
Yes, I did have a meeting with Sarah, Judy Lynn. This is what she had requested. Because of the work that you do have, instead of pursuing 2 chapters a week, which would have been necessary to complete the course, we agreed to one chapter to make the work a little bit easier for you. And also because we started 3 weeks late, that
I know,
time.
yeah, we know, but I think
Yeah.
I'm thinking is we will shorten the course so that
Well, Judy Lynn, let me just again clarify. This isn't my decision to make, you know, whether the semester ends earlier or later. This is an administrative decision. I cannot say, okay, we're finished on a certain date unless the university, as represented by Sarah, who's consulted with me, I could only follow the instructions that the university has given me. So because we started 3 weeks late, they would like the course to finish at that time. That would be the 24th. If you wish to speak with her and perhaps see if if the university will allow perhaps two meetings a week to finish a little earlier, then that's fine. I would have the time to do that, but I cannot simply end the class sooner without the approval of the university.
Yeah, I understand, Professor, but
Well, again, if you wish to reach out and make your case with her and see if they will allow the semester to end earlier, then that's fine. Whatever they decide to do, but I cannot make that decision on my own. Please keep in mind that the courses have to have a certain amount of time because of the accreditation process, according to the requirements of the educational, administration. You can't simply end the semester without completing the required amount of hours. So certainly all my years in education, I've been aware of that. I've participated in the accreditation meetings. So again, it's for them to decide. If they agree to in some way shorten it, then it's okay. I was made aware that many of you are doing your thesis as you finish your studies. But again, this is their position, so I will do as they ask me to do.
okay.
Okay. Well, again, this is something that I guess is still to be worked on. But again, I am free to accommodate whatever the university decides to do. So again, if you want to reach out to her and make your case and see if there's in some way there's a way of reducing it, but again, I take no position on this. I simply, will do as they request of me to do.
Yeah, we are not making rules, but if we can have at least two chapters per meeting, so that
Well, the amount of chapters, it seems, isn't so much an issue as it is when the semester finishes. So the request to just focus on the most important chapters remaining, that's fine. I have no problem with that. Some of these chapters, again, are might not be very useful to you as MBA students in real estate. You may not see any reason to pursue some of these subjects. So again, changing the chapters to be discussed, that's not an issue. So again, from what I understand, the issue is really, continuing into the end of January, which you would like to finish sooner, and I can understand that too. I was once a student, and I know the importance of needing a little rest and finishing a semester, be able to recharge your batteries for the next semester, or if you're finishing, going off and pursuing your employment someplace. But
thank you, Professor, for understanding that situation.
yeah, no. Again, I was a student too. It was a few years ago, but nevertheless, I understand the importance of some rest. In fact, I had inquired about taking some time off now, because there's nothing in the, say, university calendar that requests a break for the Christmas season. So I was told that I could do it at my own decision. So that's why I said, well, then on the 20th, we'll take that week off. I'm sorry, the week of the 27th, which is the Christmas week, that we'll take that week off. So I have a chance myself to rest a bit from my work. So I look forward to that as well.
Okay.
Okay, so we'll leave it, Judy Lynn, we'll leave it at there. I know you've been here since the very beginning. You're one of the few that have stayed with us, so some of the others may pick up the information from you or watch a tape of the class. So we'll leave it at this, that we will meet next week, the 20th. The chapters are in Moodle. We will have the week of the 27th free. The 20th, we'll discuss one chapter, and I'll give you a few questions to serve as an exam. And we will meet again then on January 3rd. So you'll have 2 weeks to complete that assignment. So the 3rd, the 10th, the 17th, and the 24th, we'll have 4 meetings once we return in January. And the final day is the 24th, according to what the university has said to me. So I'll leave it to you to reach out and see if there's any way of changing any of that to your own satisfaction. But I could only do
thank
what
you, Professor, for your patience explaining this. So that's okay. I understand your situation also. And thank you for understanding also our situation and our side, being as a student. So
Yes,
we'll
no,
go back to the course. So 27 is our midterm.
Yeah, well, yes, the 20th, I'll give you post a few questions to serve as a midterm exam, and then you'll upload that in 2 weeks when we meet again on the 3rd. I'll have you upload it or finish the day before the 2nd, which would be on Tuesday, so that we can discuss the exam if you'd like on the 3rd. If not, then we'll pick it up the following week on the 10th. But on the 20th, I'll post a midterm exam.
Yeah, what's the coverage of the exam?
It'll be all the chapters that we have discussed it to that point. So today we're going 10 and 11, and next week we'll do 12. So I'll give you some essay questions, discussion questions, rather than the multiple choice, which are very specific. I'll just give you some, just like the study questions, and ask you to elaborate on some of the key concepts that we have discussed so far.
Okay, I think that's more.
Yeah, the multiple choice questions are very specific and a bit more challenging. So I'll give you, again, more general, open-ended, as we call them, discussion questions of some of the key concepts from chapters 1 through 12.
Yeah, so next meeting, we will not meet on this coming Wednesday?
Yes, no, we will meet on the 20th. We will not meet on the 27th. Okay, so today's the 13th, December 13th. We'll meet today. We're meeting today. We'll meet next Wednesday, December 20th, discuss chapter 12, and then have 2 weeks free. The 27th will be free, and then we will resume the class on January 3rd.
Okay.
Again, just as a point of reference, any university, U.S. university, of which I have more knowledge than I would of universities in other locations, must conform with a certain amount of hours per class. And this is for purposes of accreditation, receiving licenses to continue, so on and so forth. So because the class started late, in some way, those hours have to be made up. At the moment, the decision or request has been to extend the semester a few weeks. And I certainly could understand your point that you would prefer not to do that. But if you wish to reach out, because I had mentioned that, and it seems that it wasn't the preferred decision. If you wish to reach out and see if we can have perhaps 2 classes, Wednesday and some other day, that would be, I would be able to do that. But again, it isn't a decision of mine to make. Okay, let's move on. Let me give you the answers to the multiple choice questions from last week before we move on to 10 and 11. Okay, the first question, the element of an adjustable mortgage is B, index. Number 2, which of these aspects of a loan will be addressed? That will be A, late fee. 3, a lender may reserve the right to require prepayment. That would be C, demand clause. 4, when a buyer of a property with an existing mortgage acquires the property, that is E, subject to the mortgage. 5, which of these points in a mortgage loan would be addressed? That would be D, escrow. 6, to finance the purchase of a property, it is D, contract for deed. 7, ways that a lender may respond to a defaulted loan. D, accelerate the debt. 8, if the lender is a standard first mortgage, answer is A, acceleration clause. 9, a common risk that frequently interferes would be D, bankruptcy. And 10, the characteristics of a borrower that can be considered is C, Equal Credit Opportunity Act. Okay, if there's any questions, just let me know if you wish to discuss it now, or simply reach out, email me, and I'll get back to you as soon as I pick up the message. Chapters 10 and 11 deal with mortgage financing. I'm not going to get into the subject in any deep depth of the subject, simply because mortgaging and the people that work in mortgaging, this is an industry in itself. In order to become a mortgage person, you have to have a license. You have to take a course in this field. And just as if you wanted to be a realtor, you have to study, take a test, and get a license. So I wouldn't expect you to possess the level of knowledge that someone with a license would possess. I would just like you to know the basics of mortgage and mortgage banking. One reason is that you may, if you have an interest in the field of real estate, may consider working in the mortgage sector of real estate. You can work for a bank in their mortgage department. You can work for an independent company that serves as an intermediary between a borrower and a lender. most people, if they want to finance the purchase of a home, will go to a bank. However, some people or some communities may have perhaps one bank, very small communities. Maybe a borrower does not have a good relationship with that bank, may have had some issues in the past, so they'll look for some other source of financing. And this would be a mortgage banker, also mortgage broker. We'll get into that as we proceed. But a mortgage banker provides services, and a broker as well, that a bank provides. So in the event that you may have an interest in pursuing this, you could find a position or employment in this field. And with that in mind, you should know the basics of mortgages. It's always good when you go in for an interview, regardless of what the interview may be, that you already know and demonstrate knowledge of that particular industry. The interviewer will look highly upon you if you come prepared and you come with basic knowledge of the field, instead of walking into an employment situation and say, I'm looking for a job, whatever it is, I'll take it, just pay me. I mean, that, of course, is not the way to do it, but so this is why I say that because this is an industry that is licensed, we cannot cover all of the finer points, nor do I feel necessary that you should possess the same amount of knowledge that you would if you went to take the mortgage banking test. The same thing applies to being a realtor, and the same thing applies to being an appraiser. We discussed appraisals last week or the week before, and we said that you need to take a course, you need to take a license, get a license, be licensed to do this. So these are fields that require a considerable amount of knowledge, and one cannot offer services as an appraiser, as a realtor, as a mortgage person with really very little knowledge of the field. The first part of the chapter, it's sort of a historical view of mortgages. It gives the reader, and of even myself, some history, some perspective of how mortgages came about and how they have evolved in today's economy. For the most part, going back maybe to the 1930s in the U.S. and maybe even earlier, very few people can afford to have their own homes. It was very hard to get financing for a home. A lender was always concerned whether the borrower could pay the money back. So it was very difficult to get a loan. If you could secure a mortgage back then in the early 1930s and perhaps early 40s, the term of the loan was often 10 years, maybe 5 to 10 years, depending on the bank. That in itself made it very difficult for borrowers to pay back the amount borrowed. Now, certainly in those days, a new house could have been $30,000 or $40,000, but a person may be making $100 a week or $5,000 a year at that time. So, relatively speaking, while the cost of the purchase price of houses was not close to what it would be today, people weren't making as much money as they are today. So, very few people were able to purchase houses, and if they did, they were required to pay it back within, let's say, 5 or 10 years. Then we have entering a period, if you enjoy history, then we're getting into a period, let's say, of World War II. and people were in the military, and then millions of people returned from the military and therefore sought employment. Factories were transformed back from military production to consumer goods production. People started making money again. The US government attempted to assist people to buy homes because it was good for the economy. You buy a home, you are aiding the banking industry, you are aiding the construction industry, every material that has to do with making a home. Demand for those materials, wood, cement, electrical stuff, all would increase. People would be working, companies would be making money, and the economy would be growing. One difficulty that banks faced in the early going was that if they did give you a mortgage, let's say for 10 years, they were taking money away from reserves, from deposits. I mean, how does a bank work? A person goes in and deposits money. The bank takes some of that money and lends it out. It could be a commercial loan. It could be a mortgage loan. Lends that money out at an interest rate, which, assuming the borrower pays back without a problem, will generate profit, for the bank. So the bank takes your money, lends it out, and then for a short period of time, charges interest. That interest is converted into profit, and then the bank makes money, and this continues. So if the bank lends out money for mortgages, however, for 10 years or 15 years, how long can they do that before they don't have really enough money even to function? Well, that's a hypothetical situation that a bank would never allow to happen. But when the government stepped in to facilitate the issuance of mortgages, then the whole situation changed. What the government said to banks, you can issue mortgages now up to 30 years, and we will insure the money that you have loaned to banks. And not only that, we will allow you to sell that mortgage to someone else, and you will then receive the money back that you have loaned out. This would allow a bank to issue a 30-year mortgage, let's say $100,000, and sell that for $98,000 to someone who would then make a little profit. And then the bank could then take that money and lend it out again to another borrower. So by offering, number one, insurance in the event that some people don't repay their loans completely, and by offering to pay back to the bank the amount of money that was originally lent out. So the bank was given back the money that it lent out, allowing them to re-lend again and make some profit on the original mortgage. And then they sold it to another company and then began the process again. So that stands out really as the key to how the mortgage industry evolved into what it is today. The government agencies referred to as Fannie Mae and Fannie and Freddie Mac are government agencies that purchase mortgages in what is referred to as the secondary market. They don't issue mortgages, they simply buy them. So bank issues a mortgage, I'm simplifying the process, of course, and then can sell that to another mortgage lender, a mortgage investor, or sell it to the government and then receive back the money that was originally loaned out, and the process begins again. So therefore, freeing up millions of dollars in mortgage loans to facilitate the purchase of homes and, of course, the construction of homes. See, that's the key too. I mean, a person could buy a home and you say, well, okay, well, the transaction is simply between a borrower and a lender. But if you try to imagine what it was like in following World War II, when people came back, the mid-1940s and 1950s and further, and this, of course, for countries, other countries as well, the economy began to grow. People began to demand housing, and then the process began to grow as it is today. A mortgage loan, as we mentioned weeks ago, consists of two elements. One was the promissory note, which specifies in detail the amount of money that's being borrowed, for how many years it's being borrowed, and what is the interest rate. So a promissory note would say something based on today's terms. We are issuing a mortgage, a loan to you for $300,000 at 6.5% for 30 years. So you will pay a fixed amount each month for 30 years of whatever that comes out to. The second part of the process is the mortgage itself, which says to the bank that we can take this home from you in the event that you don't pay off the loan. So again, it is a sort of a bit unusual. The concept of mortgage actually includes a document saying mortgage and another document saying promissory notes. In the early going of the modern era, the mortgage length of time was 30 years. The government and banking decided that 30 years is, I guess, an adequate time for issuing a mortgage. And this would be issued at a fixed interest rate. The original mortgage percentage loaned out to consumers or borrowers was fixed at 80%. So what is called a conventional mortgage meant that a $100,000 home, a borrower could borrow up to $80,000 and would have to put down $20,000 of his or her own money. Now, of course, you can't buy a home today for $100,000, but nevertheless, that's the point. 80% the bank will provide, and 20% is what the individual is to provide. It's often referred to as an LPM, a level payment mortgage, meaning that the same amount of money is paid out for the length of the mortgage. What will vary is the amount of money that's paid to reduce the principal, that $80,000 that was borrowed in principal, and the interest according to what the loan was. Again, today's rate is about 6.5% interest rate. As we move forward in time, as I said, this is more of a historical perspective of mortgages. As we move forward into the 2000s and 2010 and so on and so forth, the mortgage industry, this is really a decision of the mortgage industry, said, you know, it's hard for most people to put down that 20%. Imagine if we're talking about a a $400,000 home. $400,000 home, if the borrower has to put down 20%, that means the borrower has to put down $80,000. The bank puts up 320 and the borrower puts down 80,000. Not many people are walking around with $80,000 in their pocket or $80,000 in their bank account. So, in the true fashion of capitalism, companies that are in this business said, well, how can we manage to facilitate the growth of mortgages and at the same time make it easier for borrowers to borrow money? Well, this was resolved by the issuance of private mortgage insurance, referred to as PMI. Private mortgage insurance allowed, I shouldn't maybe say allowed, but it permitted a borrower to put down less than the 20% required to obtain the loan. In order to put down less, the lender, the bank, wanted some insurance that the borrower was going to pay. So the borrower then, if you can't put up the 20% on a conventional mortgage, can request PMI. That would be an added cost to the mortgage. But nevertheless, you can now obtain additional money to make that down payment easier for you. So with the introduction of PMI, private mortgage insurance, a borrower can obtain or reduce that 20% that would be part of a conventional mortgage, and may now even today just put up like 5%. So it's 95% finance to purchase the home and maybe 5% that the borrower puts down. It could be even a little bit less, 90%, and 10% the buyer puts down. In some types of financing, for example, we'll see this in just a bit, veterans returning from military service can often get 100% of the purchase price paid as borrowed for their mortgage, so they wouldn't have to put anything down. And the idea was, if they're in the military, they really did not have the ability to save the amount of money required to have obtain a conventional 80-20% mortgage. Following a bit on the text, okay, Fannie Mae, Freddie Mac, government-owned agencies that will buy mortgages from a bank, give the money back to the bank, and allow the bank to continue loaning out. This is referred to as the secondary market. The government is not issuing the mortgages. The government is buying mortgages from mortgage brokers and banks. Okay, the oldest form, again, the mortgage loans were not guaranteed by anybody, so a bank had to be very careful that the person who was borrowing had the ability to repay. Now, you could say, well, if they couldn't repay and simply foreclose or say to the bank, here's the keys, I can't pay anymore, well, the bank could resell the property, which is what they do even today. The problem is, what happens if the value of the home declined such that the bank could not obtain the amount of money they loaned originally. Let's say they loaned $100,000, but after a few years, that home lost money and was down to 75,000. Well, the bank might be able to sell it for 75,000, but they would lose 25,000. So it wasn't so much a question of, well, can I sell it? Yes, the mortgage document would state that the bank can use the home as collateral in the event that you fail to pay. But the risk to the bank is that the value of the home had declined either through poor care of the home or economic conditions. And then the bank, even if they sold the house, would not be able to get the amount back that they loaned. A conforming conventional home loan, what is considered a conforming loan, is one that meets the requirements of Freddie Mac and or Fannie Mae. This has really more to do with the procedures for obtaining a loan. And mostly all loans today issued by banks are conforming loans. Why? Because the bank wants to be sure that either Freddie Mac or Fannie Mac agencies can purchase the mortgage from the bank. So I want to do it, says the bank, the way the government asked me to do it. I'm going to use a standard note, a standard mortgage, going to have a standard appraisal, such that the bank, the government will say, okay, you did everything according to how it was required. So here's the money, we'll buy your mortgage and allow you to issue new mortgages. Even though this book is fairly new, the upper limit of what would be a conforming loan, as the slide shows, was $510,000. Today, it's up to $766,000, almost $767,000. That would be the upper range of what is considered a conventional home loan. In other words, the bank could issue up to $766,000 today in terms of the mortgage, and still have some guarantee that that they'll get their money back in some point. If you were to buy, as we see here in Florida, which is some areas are very affluent, and of course any area for that matter, if you needed more than the $766,000 today, that is referred to as a non-conforming loan. So a wealthy person wants to buy a home, a few $1 million, and needs to finance it, wants to finance it, and can show that they are capable of meeting mortgage payments, they will find financing. And banks also give them money, but they'll have to be a little bit more careful, because if you're borrowing 2 or 3 million versus 100,000, the risk is much greater. So banks have to be very careful in issuing loans of that amount. The non-conforming loans are also referred to in the industry as jumbo loans. Jumbo meaning much higher than the typical mortgage loan. Okay, this is an example of the private mortgage insurance, the PMI concept, which is intended to assist borrowers who cannot meet the mandatory 20% what they have to put down, as well as to protect the lender in the event that the borrower cannot afford to pay. So private mortgage insurance generally required for loans over 80% in value. If it's an 80-20 conventional mortgage, then it isn't necessary to obtain PMI, private mortgage insurance. In the event you want to borrow more than the bank the issuer will say to the borrower, you need to get PMI and pay the fee for doing so. Okay. These are some of the terms that you would pay if you need a PMI, 2.5% of the loan in single upfront premium. Well, whatever it is. I'm not concerned with the details, and nor would I ask you to be concerned with the details. Once again, what is the purpose of PMI, private mortgage insurance? Private mortgage insurance allows borrowers who cannot meet the 20% standard required to obtain a conventional loan can purchase insurance saying that, yeah, I can meet my payments and I'm willing to pay a little bit more. I don't have the money as a down payment, but I am earning this amount of money from my employment, so I can meet the monthly payments. It's just that I don't have 20% of whatever amount is that's required. The benefit of PMI is that, again, it allows buyers who cannot meet the minimum standards of 20% to still buy. And this is what the economy is asking. You want more business, more purchasing, more construction, and also more protection for the lender that the borrower can pay and that they'll get their money back. Now, you will pay PMI indefinitely, but the concept does provide that after a number of years, okay, think of it this way, you're borrowing 90%. Let's say a PMI is you're putting down 10% and paying PMI, and the borrower is putting down 90%. So it's a 90-10 split, with the borrower paying extra in order to facilitate the loan. Once that loan value, once you have paid off, now 90, let's say the slide says 78%. Once you have paid off 12% of the loan, then it's possible that the PMI will go away. The person, the bank issuing the PMI, the insurance company will say, okay, you have demonstrated that you can pay. You haven't missed any payment. There hasn't been any problem with you. So we will terminate the PMI because we now consider that you don't have a problem paying your loan. So PMI can disappear in time once the value of the loan has been paid down. Okay, this would be an example of what the insurance will cover. A house amount 200,000, the loan 190, meaning the person was putting down 5% only. So the PMI was insuring the top 30%, first 57 in losses. Borrower pays down to 188. Lenders then defaults. The bank consolidated 180. So the bank's loss, the lender's loss is 8,000. With loss less than 57,000, the PMI will cover the $8,000 loss to the bank. Okay, I wouldn't ask you to compute this or calculate this, but to understand what PMI does and how it facilitates the growth in the mortgage market, and of course the overall construction industry. The construction industry is a very significant, part of the overall economy in the U.S. As a realtor, we receive information on new housing starts in our communities. And a very positive sign of the growth or health of the economy is how much new construction is going on in your community. And when you see something like new housing starts declining from previous periods, it's always like kind of a negative impact on the economy. It's always very healthy when construction is growing, of course, for the industries that are involved, as well as the banks. And just consider everyone involved in the construction industry. It's the people who are involved in the raw materials themselves, the wood, the cement, materials. Okay. You also have people involved in the transportation of the materials. So new construction is a vital part of any economy, especially in the US, and economists follow the trends in construction very carefully as a sign of where the economy is going at a particular moment in time. This is why the government, the US government, going back again to the 30s, 40s, 50s following World War II, took an active step to facilitate the growth of the construction market, new housing market. Okay, there are some other players involved in the construction, in the housing industry. Let me just see something. Let me just go ahead for a second. Before the topic of FHA comes, there is one or two things in the text that are mentioned. They don't seem to be part of the slide. An adjustable rate mortgage, ARM, ARMs they are referred to. An adjustable rate mortgage. A conventional mortgage and the mortgages that we have been discussing are fixed rate mortgages. That means that the amount of interest the borrower is paying does not change over the course of the life of the mortgage. If your interest rate is more or less today, if you buy a home today, about 6.5% interest, you'll pay 6.5% interest throughout the 30-year term. When things were a little kind of slow back in the early 2000s, 2004, 5, more or less in that area, mortgage lenders began to offer adjustable rate mortgages, ARMs, simply because the interest rate at the time, which reflects in part the state or health of the economy, happened to be very high, up to 8%. So they said to buyers, okay, I tell you what, we'll give you a 4% interest rate for a 5-year period. So instead of the $2,000 monthly payment, you would pay $1,000 monthly payment for a period of 5 years. After 5 years, we will change the terms of the mortgage. This allowed people who could not afford the $2,000 a month at 8% interest to say, okay, I'm going to buy a home. Not only did it allow them to buy a home, it also kind of motivated people, buyers, to buy more than what they could afford, to buy bigger homes, more than they really could afford considering where they were working. So at a lower interest rate, buyers jumped in and said, okay, well, instead of paying $2,000 a month for an interest loan, I only have to pay 1,000, you're saying, for 5 years? And the bank says, yeah, and we will meet again in 5 years, and then we'll discuss it. But what happened? Let's fast forward a few more years to 2007, 2008, and all of a sudden, that 5-year term ARM expired. Interest rates were even higher. If a bank loans to you a house at 4%, at 4%, what did I say, 4%, and the interest is 8%, the bank is really losing money because they could be selling that house or giving a mortgage loan at 8%. So after the 5-year period and banks began to reassess the interest rate, that interest payment that the person was paying 1,000 may jump then to 3,000. Okay, it would have been 2,000 if they could afford the home. It was given as sort of a reduction to stimulate housing, so they'd only have to pay 1,000. But after the 5 years, the bank said, well, sorry, can't do this anymore. Now I have to charge you 3,000 for this mortgage. Well, what happened? People just like went crazy. This was the beginning of what was called the foreclosure era. Some places here in Florida, and I was a realtor back then, I had just started in 2006, who had purchased homes above and beyond what they could have afford under normal conditions, were then forced to pay more in a very soft economy. So we simply said to banks, I can't do it. Here's the keys, do what you want. When you have a situation where you have much more supply than you have demand for homes, then the value of those homes declined. Foreclosures stepped in, and the banks were stuck with, with thousands of homes that people could not afford to pay. What that meant here in Florida was people buying homes. Let's say they wanted a 3-bedroom home with 2 baths. Oh, I can get this home for $1,000. I'll tell you what, give me a 4-bedroom home, 3 baths, and I tell you, throw in a swimming pool. I mean, the kids like swimming pools. So before you knew it, most people were in homes, I'd say many people were in homes that they really could not afford to pay under normal market conditions. This began a very difficult period in real estate, going back to around 2007, 8, for about 2 or 3 years. This was referred to as the Great Recession here in the US. And it was considered the fault of the mortgage industry. It was considered a bubble, a mortgage bubble, they called it. And again, what that meant was that the mortgage companies, banks, and private lenders began to issue loans at adjustable rate mortgages, or also what's called balloon payments, which meant that, okay, we'll loan it to you at 1,000 instead of 2,000, but in 5 years, you'll have to give us a check for $10,000 unless the situation changes. People say, okay, I'll worry about that in 5 years. I can always get another loan for $10,000 and pay the bank. Well, it so happened from the time the first ARMs were issued to 5 years later that the economy had declined considerably and people could not meet their payments. And therein began what is called the Great Recession of that period. Okay, the Federal Housing Authority, the FHA, guarantees loans made to borrowers. So the FHA stepped in to help the Federal Housing Association administration stepped in to help companies by providing insurance to lenders. This is the same concept of the earlier Freddie Mac and Fannie Mae government agencies that acted to buy mortgages and essentially say to the lenders, don't worry, we'll pay you back the mortgage so you can issue new mortgages and then make more money. So in essence, what the whole industry needed and required was really insurance. And once the federal government stepped in to provide insurance for the industry, then the housing market just began to accelerate. Okay, the FHA created, again, I'm not going to bore you with the various sections of it, but it allows, again, the banks and the mortgage brokers to be able to insure loans made to lenders. It's not going to insure everything. It's going to insist that you meet certain standards, but it will insure almost like pretty much like private mortgage insurance, PMI, that the insurance is paid by the borrower, but it protects again the lender's risk to the borrower. Let's just look at an example. The housing price is 203,000. It's appraised at 200,000. Consider we had mentioned, I think, in the very early going that the market price represents what someone feels a house is worth. The tax man in every community may have a different point of view. So in this example, the appraised value representing the amount that the tax appraiser of that specific community sets for that particular property is 200,000. Okay, FHA closing costs, the maximum loan 193. They'll provide insurance up to 0.965, figure out the numbers, whatever. So that means that in order to achieve obtain an FHA loan, the borrower would have to put down 15,000.
Professor, what is 193?
193. Where did you see 193?
Yeah,
okay,
where did you get the
the actual
193?
down payment, yeah, 203 minus the 193 would be the 196 minus the 3,000. The 193 plus the 3,377 gives you 196, but the actual payment then 203 minus 193 would be the difference. Okay, here it is up there. The implies the maximum loan is 193. 200,000 times 0.965 is the amount that they will insure. The UF, I'm not quite sure what the UFMI, well, MIP would be the mortgage insurance. This is, I guess, the insurance that they will, the rate that the individual would have to pay to obtain, again, the insurance would be 1.3% essentially as a percentage, 0.0175 times the 193. Where does 193 come from? Okay. 95. All right. Let's see there. Well, 193 is 200,000 times 0.965 is the amount of insurance that I guess the government will provide times 0.0176 gives you 3,300. Okay. No, again, I'm not following the numbers. I'm not quite sure what the UFMIP would be. Okay, upfront. Okay, here we go. The insurance requires two premiums, the UFMIP upfront mortgage insurance premium. So the upfront, what the borrower would have to pay would be an additional 01.75. In addition, the borrower would have to pay a loan to value ratio of 40% to 0.85%. Okay, if you're following in the text, I'm on page 250. Okay, the example in the text can be found on page 251. Okay, let me go consider the text as well. Okay, consider the purchase with an appraised value of 200,000, the actual sale price of 203,000. Okay, was it appraised at 200, but it sold for 203,000, and the loan was 30 years at 6%. What we need to know is how much can be borrowed in total and what proportion must go to the upfront MIP. The maximum Federal Housing Association loan, excluding the UFMIP, cannot be greater than 96.5% of 200,000 or 193,000. Okay, so find the upfront fee cannot be greater than 96.5% of the purchase price. I'm sorry, 96.5% of the appraised value, or 193,000. So they cannot insure more than 193,000. Okay, the base amount 193,000. 1 minus 0.035 times 200,000 Okay, well, the information is worked out on example 10.2, page 251, and reflects over here. The actual loan amount, the payment amount of a loan of 196 would be 1,177. Okay, I mean, I wouldn't ask you this. It's unnecessary. It's really very technical information that the FHA would have to work out if you wanted to get an FHA loan. Let me just go back a second because I don't think I made this clear enough. Most people, when they needed a home, go to a bank or a mortgage lender and get a conventional loan. Okay. In the event that you cannot do that because your credit is not very high or you have problems in the past with your credit history, you can seek a Federal Housing Administration loan. This is loans, again, made to the borrower. You can say, I need an FHA loan because I may not be able to get a conventional loan. The FHA, because it's guaranteeing the loan made to the borrower would have to pay more than she would if she got a conventional loan, conventional mortgage. The FHA is similar to what we'll see in a moment, which is a VA loan, a Veterans Administration loan. What the VA does is they insure homes, loans made to military people who want to buy homes. So if you cannot get a conventional loan, and let's say you are a person who just concluded a few years in the military, but had no work experience and maybe no credit history, it would be hard for you to walk in and say, I need a conventional mortgage 80-20. In this way, you would have to turn your mortgage, the person you're working with would say, well, then let's try and get an FHA loan for you. If you are a military veteran, then the mortgage company or the bank would say, then what I can get for you would be a VA mortgage. In both cases, the FHA and the VA provide insurance to the lender, simply because the borrower does not have the credit history in order to obtain a conventional mortgage. The FHA allows up to 96.5 is what we can see here. Again, in the text, 96.5 of the actual purchase price, meaning that you are putting down approximately 3.5% plus whatever fees you would have to pay. So this is far more favorable than the 80-20 conventional mortgage. But it applies only to certain people. Okay, let's catch the Veterans Affairs. Okay, Veterans Affairs loans are limited to qualified veterans. The government can guarantee up to 1/4 of the loan, and the loan can be up to 100% of the value of the purchased property. Okay. All I would again ask of you, or for you to be familiar with, would be that there are certain mortgages or certain financing available to people who cannot meet the normal standards for purchasing a home, in which you would put down 20% of the purchase price and the bank puts the 80%. If we just move up a little bit from the conventional mortgage time, we now know, because of PMI, that a buyer can pay extra for insurance, essentially, that will allow them to put down less than 20%, which is the conventional mortgage ratio, to buy a property. Over the more recent years, again, a bank can offer whatever they would like. A VA will protect up to 100%, but a bank could do that too. I mean, the rates are not determined by the government. How a bank conducts its business is really the bank's business. Of course, you can't do anything that might be inappropriate or illegal. But the thought of the strategy of giving somebody who can't afford the 20%, that emerged from the banking industry, because again, in a free-based economy, companies are saying, well, how can I make more money? How can I stimulate the purchase of my product? So by issuing insurance, of which the borrower would be paying, then they came up with these vehicles that would allow people to buy homes without putting down the 20%. Sometimes it would be, again, it sort of goes up gradually. If you trace the history of this when it first came out years ago, it would be, let's say, from 80-20 to 85-15. And then it went to 90%, and then you put down 10%. And then mortgage companies and banks got even more aggressive, knowing that they exist in a competitive environment. They're competing with other mortgage lenders. When I encounter a potential buyer as a realtor, one of the questions I ask the buyer is, how are they going to finance the purchase of a property? If they tell me, well, I'm going to need a mortgage, I will then say, do you have a relationship with a mortgage company or a banker? If they say no, then I would suggest to them a few mortgage companies for them to call and say, listen, call these people, request an interview, ask what their interest rate is at the moment. They will ask you for your credit history. They will do a credit check on you, and then select the mortgage company that gives you the best rate and also would have the lowest closing costs. Okay, so the point is that banks are in competition with other banks and mortgage brokers and people in the industry. So from what became 80-20 to 85-15 to 90-10 to 95.5% is where the industry is today, excluding the VA, which will guarantee, again, 100% loan in cases due to the again, service that military people have given to their country. A home equity loan, or the mortgage types, let me mention this. You buy a house for $200,000. 10 years later, you owe maybe $150,000. So you paid off $50,000. That home that you bought for $200,000 now is worth $250,000. So actually, you're making $50,000 on the market value of the home. You have paid off $50,000 of your mortgage. You have what is called $100,000 in equity. That means if you sold your house today, you'd only have to pay the bank $150,000. That's what you owe them, and you can sell it for $250,000. So the difference minus costs is $100,000. That is your money. However, that money is tied to a fixed asset, which is your home. If you need some money for whatever reason, maybe a child wants to go to college or law school or medical school, and you have to pay $20,000 or $30,000 immediately and do not have that amount in the bank, what you can request of the bank that has your mortgage first is called a home equity loan. But the bank will say, okay, you have $100,000 in equity in your house. We will loan you up to $100,000 at an interest rate of what X percent. This is called a home equity mortgage. What you are doing really is borrowing your own money, because that's $100,000 is yours. If you wanted to sell your house tomorrow, you'd walk away with a check for $100,000 less fees. That money is your money. You are actually, the bank is actually lending you what you have earned in the house. It's your money at an interest rate of whatever it may be. But it's not, I mean, while it might be a bit unusual to be paying interest on your own money, the purpose of a home equity loan is that it does give you access, liquid assets to funds that you do not have at the moment, but you do need. So, and they work a little differently than a personal loan, in the sense that the bank would say, okay, we will loan you $100,000 and it stays in your account. You then can access any part of that whenever you need it. So let's say you say, okay, well, I'll take the interest, I'll take the $100,000 loan. If I need 20,000, then you would pay interest on 20,000. So essentially, you have that amount of money available to you in the event you need it. If you need all of it, you can take all of it but you will pay the interest on the full 190,000. You are borrowing again. The irony of it is that you're borrowing your own money and paying interest on it. But the benefit of it is that you need money and you don't have it. You have equity tied into your homes that you cannot access unless you request and obtain a home equity loan. Okay, another type of mortgage is called a reverse mortgage. Let's look at a couple that purchased a home in their 20s and now are in their 60s, let's say 70s. Let's make them a little bit older. They have paid off their home, their mortgage. That home, which maybe was $50,000, it could be worth now $250,000. But they don't have any income. They're living off, let's say, Social Security or some sort of pension, depending on where you live. So they have an asset that's worth $250,000, but they have very limited monthly income to live on. For whatever reason, if they feel that they need more income, they can go to the bank and say, I would like a reverse mortgage. What the bank is going to do is first conduct an appraisal to see the value of your home. They're going to say, okay, it is worth $250,000. So what we'll do is this. We will give you a monthly payment of, let's say, $2,000 every month for 5 years, knowing that these people are elderly anyway. In the event of the death of the owners, or in the event that what you often see here in Florida, one of the couple passes, the other has no interest or cannot live by themselves, so the home is sold. So the bank then would obtain from the sale of the home what they have loaned to that couple. Okay, so what is a reverse mortgage again? A reverse mortgage is occurs in a situation where, let's say, a couple has paid their home completely, or as the slide says, owns over 80% of their home. Now, we're talking about over a 30-year period. So in probably all cases, the original value of that home has doubled or tripled over the years. So you have an elderly couple living in a home that may be worth quite a bit of money, but has no income flowing in except what they have maybe through pensions or Social Security, and they need more. So the bank will, on the basis of that home, issue you a reverse mortgage, which says the bank will pay you a certain amount, as opposed to the regular mortgage where the borrower pays the bank. In this case, the bank will pay the borrower a certain amount of money for a certain period of time. That is essentially a debt that the elderly couple, the owners, will have with the bank, but it allows them to receive some money that they feel they importantly need. Excuse me. So that money then is repaid at the time that the couple sells their home or passes away. The bank then has an obligation, a legal right to pay back, to get the money that they have advanced to the elderly couple with interest. Okay, traditional mortgage, the person putting into the house. The reverse mortgage, the bank, the house essentially giving back to the couple, or the owner, I should say. So in time, the equity that the couple has, which is a full 250,000, is then lessened by the amount the bank is paying. Let's say they give you $50,000 over a 5 or 10-year period. Well, then you still have let's say the house is still worth 250,000 5 years later. You still have 200,000. That's your money. You have to pay the bank back the 50,000 if you wish to end this. Okay, here's the money you've given to us. We don't need it anymore. We're moving into moving back with the kids or into assisted living. Sell the house for 250. We owe you 50, and then we walk away with 200,000. Okay, the amount of loans insured over time by the FHA, a little outdated. It goes up to 218. Okay, other forms of mortgage, the interest-only mortgage. Again, these are vehicles that mortgage companies and bankers have come up with in an attempt to stimulate the business and in order to get more money. Again, as housing costs increase, as the value of a new home gets higher, it becomes more difficult, more challenging for a young couple to buy a home. So things like the adjustable rate mortgage, the ARM, the interest-only mortgage, where you're paying only the interest rate. Let's say today's interest rate, as I said, is about 6.5% on a new home. So let's say you pay just the interest and no principal. And then at some time there's a reckoning because the bank simply wants, well, it's going to get its interest, but would probably also say, you know, we want some of the equity. But notice it's really also mostly used in commercial property. Okay, the concept of amortizing means that a loan is paid completely over a full period of time. A conventional mortgage is an amortized loan, 30 years for the same amount of money. Okay, that's what this amounts. Again, I wouldn't ask you the more technical things, the recent hybrid ARM. Leave that for really the professionals in the industry. Okay, I don't want to go into that again. I do want to see if there's okay. Let's take a look at a concept called refinancing. You have, if you did purchase a home at a time of higher interest rates, your mortgage may allow you to refinance. That's like saying to the bank, I would like a do-over. You would only attempt to refinance your original loan when interest rates have gone down substantially. For example, if your 30-year mortgage is at 8%, there were times when that was 12%, much higher. If your original mortgage is, let's say, 8%, and current mortgages after, let's say, 5 years, you own the house, or 10 years, are now at the moment, remember, interest rates fluctuate. So it's at 8, but maybe 10 years later, it's now down to 4%. You can say, I would like to refinance. It could be with anybody, but the refinancing means is that the original mortgage will be repaid and a new mortgage will be issued. So instead of paying 8% interest on your mortgage, you would now be paying 4% interest. The savings would be substantial. If there's a negative involved in refinancing, is that, let's say you had a 30-year mortgage, you've paid off 10 years, so you owe 20 years on your mortgage. If you refinance, the new mortgage would then go back to the 30-year period. So now you could say, my gosh, if I live long enough to pay the 30-year mortgage, I've already paid 40 years of mortgages, because the new mortgage would be the full 30-year period. A second disadvantage of it would be that there is a cost to refinance. The banks, the people involved, charge you quite a bit in order to do this. Why? The banker's fee, the lawyer's fee, the appraiser's fee to see the value of the home can be quite high. So if you wish to refinance, let's say you're paying $3,000 a month, and if you refinanced at today's interest rate, you can pay $2,000 a month, which is a third less, and you could do it with a financing cost of maybe $3,000 or $4,000. You'd say to yourself, I'm saving $1,000 a month, and I have to pay $3,000 or $4,000 in fees, so sort of like 3 or 4 months additional. But after that, I'm only going to pay what I say $2,000 for the next 30 years. I think that's a good deal. So that's how to approach refinancing. I have refinanced our home here in Florida once before, when interest rates declined quite a bit and the savings were quite a bit. However, I had to consider fees from about 4 or 5 different mortgage companies, and some were quite high, until I found someone that would issue the refinancing of the mortgage at a more reasonable amount. I eventually selected that company. So I had refinance, but then again, you add the additional years to the mortgage. Okay, so refinancing is tearing up the original mortgage, issuing a new one at today's lower interest rates. To save 1 percentage point is not worth doing it. In other words, if you're paying 8% interest and the interest rates go down to 7%, it's not worth it, because the fees will not, the benefit may be just a few $100s a month you will be saving, but to pay, let's say, $5,000 in fees just to save $200 a month, it's like costing you 3 or 4 additional years in order to recuperate the fees that you would be paying. But if the interest rate drop is at least 2%, 3%, 8 to 5%, 8 to 4%, you would save substantially in your monthly payment, at a cost, again, of that fee. The amount you would pay in fees is a function of the value of the mortgage. You pay much more if your mortgage is $1 million than if your mortgage was, let's say, $200,000 or $300,000.
Professor, I have a question.
Yes. Yes.
Yeah, about the mortgage. If I'm, like, for me, instance is when I go to the bank, they say that I have a 10,000 credit limit. If I use it in a mortgage, can I use it again also for buying ticket or anything that I can use my credit card, or my credit is stuck only on the mortgage?
Okay, anytime anytime you do, you purchase something, your credit situation will change. For example, if we have, as a realtor, I meet somebody who wants to buy a home, and I say to the person, as I mentioned before, are you going to finance this home, or are you going to pay in cash? If they say to me, I'm going to finance this home, I tell them, do not buy a new car. Do not buy anything that would substantially increase your credit card debt, because when they investigate your financial situation, they will see that, let's say you just bought a $40,000 car, or you just went on a trip to someplace and added $3,000 or $4,000 more to your credit card. So generally speaking, Judy Lynn, if whatever situation exists at the moment, let's say you get a mortgage, would be changed by any change in your financial behavior. So again, not quite sure exactly the situation you are referring to, but whatever it is, it's like a photo. You take a photo of your financial situation at the time the bank is considering giving you the mortgage, and also the interest rate that they give you. There is some variation. They can play around a little bit with the interest rate. For example, if your financial situation, your credit rating is average, then they say, well, we charge you 6.5%. But if your credit rating is excellent, they may be able to lower that from 6.5 to maybe 6.25. So you're saving a quarter interest rate, which, depending on the amount borrowed, could be $50 a month, $100 a month, $200 a month. So to answer your question again, any decision that you make will affect your financial behavior. So did you say you were thinking of getting a mortgage?
Yeah, I'll get a mortgage. I'll use my credit, but can I use
Yeah.
it? While I'm using that credit in the mortgage, can I use it in another things, like I will buy something online, I'll buy ticket like
Well,
that, whatever, or
yeah,
no?
well, that depends again. If you have already obtained the mortgage, you already signed the papers and
Yes.
everything is final, then whatever you do, you're free to do with whatever your credit limits would be. If you wanted to buy something with your credit cards or whatever, you should be able to do that, because the mortgage, the papers have been signed, and the house is now yours.
Also after the sign.
But after you
Yeah.
sign, but if you say to the bank, I want to buy this house, and the bank asks you for your financial information, how much money are you earning? What is your credit card debt? They can obtain that, of course. You don't want to engage in any behavior that the bank may look at and say, no, this isn't good. If they see that you spend money very freely and you buy a lot of things, the bank may say, I'm not quite sure we can loan her money for the house, because look here, $500 for this, $1,000 trip, whatever. So the best thing to do is, during the process of obtaining the mortgage, that you just spend on the basics necessities, your food, your utilities, your rent, whatever. Until you obtain the financing, the mortgage, then you can do as you please.
Okay. Thank you, Professor, for that
Let's see.
advice. Yeah.
Okay. Don't do anything while the bank is examining your financial situation, because it could negatively impact their decision to give you the money.
Mm-mm.
Okay. That's one of the first things we tell a client, someone who says, yeah, I'm going to finance with a mortgage, and I'm going to go to my bank and ask them to fill out the papers and whatever. So the thing that we say as experienced realtors is, this is my recommendation. Do not buy anything that may negatively impact your credit. Wait till the mortgage is approved, and then you can go out and buy that car or take the trip, whatever. But just stay quiet. Don't do anything. Okay. Because the bank is trying to determine your credit worthiness, and also trying to look forward in the future for 30 years to say, is this person going to be able to meet their financial obligation for the next 30 years? We don't want to take your house. We don't want a foreclosure. We don't want you to say, I'm sorry, I can't pay the home. You remember last week we talked about short sales, when you owe the bank more than what your home is worth. You say, listen, I owe $300,000. My house is worth $200,000 due to a declining economy. But why am I going to continue paying a loan when I owe nothing, when there's nothing, I have no equity in the home? I owe $300,000 and the home is $200,000. If I sold the house today, I couldn't even pay back the loan I owe in the bank. So people say, here, bank, here's the keys, you take care of it. It will affect my credit history moving forward. You may not be able to buy a new home for the next 10 years. You may not be able to buy a new car for the next 10 years, because all of that would appear in your credit rating. But some people say, well, listen, my house is worth $200,000. I owe the bank $300,000. Well, here's the keys. That happened to all of us that owned homes during that great recession of 2007, 8, 9, 10, that 3 or 4 year period. All our properties dropped. But in my case, as many other people said, well, what am I going to do? I'm here. I'm not going to sell my home. And in time, the values go back up. That's the nature of real estate. And that's why many people invest in real estate, because while properties can go down if the economy is bad, over time, real estate, I would say almost all of the time, goes up in value, making it a very profitable investment.
Because they say that if you don't use your credit card, your credit will not go high.
Yeah, well, that's the
Yeah.
thing. In a way, it's kind of funny. It's kind of ironic that, let's say, a person coming out of college, and you have no debt, and you have no credit cards, and you have nothing. Well, the bank may say, and you want to buy a home, the bank may say, well, I don't think this person is a good credit, has good credit, because they don't have any credit. There's no history of what they're able to do. They have shown that they have never had money, and don't. How do we know if they know how to pay? So sometimes just not having any debt is not a good thing to a bank. So then you go out and you get some credit cards, and you spend some money, and you pay some money back, and then you ask for a loan or a mortgage. Bank say, okay, well, I see they have a reasonable amount of debt, and they have paid the debt off in as they should, and there's no problem. So yes, now we'll give you money. We won't give money to the person who just graduated that has no record, but we'll give money to the person who already shows that they have spent money. I read something which was kind of interesting, and that is that let's say you have children that just graduating college, and you want them to have their own credit history. What a number of people will do is, while that child is in college and not working, they will obtain a credit card in their name, in the child's name. Or let's say the parents have a credit card, and they'll say, okay, issue one to my child in our account. So the child's name appears as having a credit, as having debt rather, because that person's name appears as a holder of a Visa or MasterCard account. And encourage them to spend a little money, and then the parents will pay it off, of course, because the child is in college and can't afford to do it. But then if the child wants to buy a car on her own name, well, in her own name, or may a few years later want to buy a home in her own name, there is some history. Oh, you have a credit card, you've paid it off, fine. There is something there that shows to us that you are a reliable creditor, a person who borrows and pays off. So that I thought was a good suggestion, to give a credit card to a kid, college age, such that they do have some credit in their name, and then the name will go into the internet to get around, and maybe you'll get some offers for other purchases because they see your name. Who knows how this works in the blogosphere or stratosphere or something like that. But that's sort of ironic that if you have no debt, you may be a bad credit risk. If you have a little bit, it's okay. Well, we now know the person is going to be paid. All right, let's go through some of this. We're ending now. Example of the refinancing. I wanted to mention to you the Dodd-Frank legislation was passed as a consequence of, I'm surprised that I didn't go through these before. Dodd-Frank were two congressmen who, as Congress attempted to deal with the problems caused by these mortgage people in that period, 2008, 9, and 10, they passed proposed legislation that became known as the Dodd-Frank, DODD. I'm looking for it in the material over here. I've kind of lost it in the time. But Dodd-Frank's made some proposed legislation to put some controls on the mortgage industry. The idea was to say, you've made a lot of mistakes during this period, giving out money to people who could not afford to pay. So we're going to put some controls on. And what they essentially said is, we want to make it such that the borrower has more protection when borrowing houses, to prevent them. Really, it's sort of to prevent the borrower from making a purchase that he or she cannot afford. Because what happened back in that period was the example I gave you of the fellow who really could afford a 3-bedroom, 2-bath with no pool, said, well, if I'm only going to pay $1,000 versus $2,000 a month, or $3,000, yeah, give me a 4-bedroom, 3-bath, and throw in a pool. Which meant that person really cannot afford that type of house. So Dodd-Frank was trying to put some controls on, and not putting the blame on the borrowers, on people buying homes, but also saying to the mortgage companies that you have to be stricter, and you can't make these offers without knowing if the buyer can afford to pay for them. Because the buyer could not afford to pay originally what that house would be worth. 4 bedrooms, 3 baths, pool. The buyer could not pay for what that house would cost under normal conditions. Only under really favorable conditions to the buyer could he afford that house. But once the interest rates returned to normal, he could not afford that house. And the idea is you should buy what you can afford to buy, regardless of good times or bad times. Forgetting COVID and forgetting, being fired. Anyone could be fired and lose a job and then have trouble paying. All right. Let me conclude today by saying, I didn't really even get a chance to look at 11. Suggest you just kind of pass it. I really wasn't going to spend much time with 11 anyway. So we will meet next Wednesday, the 20th, to go over chapter 12. We will have a break for 2 weeks, and I'll ask you to work on a midterm exam. We will get back on the 3rd. And Judy Lynn, if you're still with me, then I'm saying if you wish to reach out to the to Sarah and see if there's any change regarding the duration of the class, again, that would be your decision. I will abide by any decision that the university makes. Okay, I wish you a very pleasant day and a very pleasant remainder of the week. If there's any questions, get back to me, of course, and I'll get back to you as soon as I can. All right, goodbye.
Okay, bye, Professor. Thank you.
Winnie, I see you joined us if you're still there. Okay, bye-bye.